So this is joint work with Wei Zhang, my longtime co-author and good friend, Song Ma, who at the time was a PhD student at Fuqua, is now at Yale, and Xuan Tian, who's back in China now. So I have 30 minutes. What I thought that I would do, I'll do a very brief overview, in fact, a minute overview, and spend most of my time telling you about the data that we're using for this paper, where we're going to look at activists and subsequent changes in firm innovation, just the various data sources and the estimation set up. And this relates to the conversation that we had, I think, with Rob's paper and Bernie's remarks. So we're going to face the same issues as Rob raised, and so I'm going to talk about that in that second point. And then spend most of my time telling you about what we think is happening with innovation, meaning new patenting activity, reshuffling of the current patent portfolio that treated firm own. And I probably won't have time to tell you about innovators, but I really want to get down to this point again for the same points that Bernie sort of raised. I think this is the most interesting, most challenging part of any empirical corporate paper. And in many ways, because I think we, like many others, probably cannot do a good job on causality. I think the way to compensate for the fact that you don't really have exogenous variation, you can give Carl Icahn a randomly selected firm, and it's very hard to exogenously vary the effort that Icahn might expend after sort of matching with a target firm. The way to compensate for that is to try to tell you a story about what we think is happening within the firm. Try to bring a story that contrasts sort of with an alternative hypothesis to the extent that activists sort of are bad for these corporations. So we'll try to tell you something about what is it that exactly is happening and paint a picture to help me kind of with this, to compensate for causality. So this already came up yesterday, to some extent today. I don't want to review this literature. There's a very large literature by now that looks at, for example, liquidity block formation. This is Slava's work. Looking at, for example, what Rob said about short-term price reaction, sort of what happens in long-term to equity prices. We've have work using census data, looking at total factor productivity, profitability in general. There's very interesting work looking at other firm policies. I think Mike, one one of your students on the market just last year, I think Kim, has an interesting paper that looks at internal capital markets, what happens to how cash is allocated to different divisions once the activists have come on board, sort of how sensitive are these divisions to investment opportunities when activists is there, and then sort of many more. For example, again, following where's Slava? So Slava has a very nice paper on the threat of a proxy fight. We have a paper sort of following the same footsteps saying even the threat of activism might prompt firms to take changes and kind of documents those things. And I guess, as I said, there's some work on causality, which I want to spend the last 7 minutes or so today. So large and growing literature, and nevertheless, this is sort of, I think, a quite by now well-known quote from Larry Fink. So Larry Fink sends this letter, I think, to the top corporation, top companies, and in his sort of March 2015 letter, he talks about acute pressure from every quarter companies to meet short-term financial goals, and he traces the pressure to activist shareholders seeking immediate returns. Okay, so what do these companies do in response to that pressure? They take action to presumably deliver immediate returns, such as buybacks, changing payout policy in general, underinvesting in innovation, and effectively, sort of this claim is where we want to take you to the data. And notwithstanding all sort of the work that we, sort of Julian and others have done, we want to see if we go even with innovation, there's presumably sort of has a long-term impact on firm success. See if in fact Fink sort of is correct or not. Of course, if you kind of skip 1 year forward to his follow-on letter, by then he's much more sort of amicable, but certainly not as aggressive against activists. Those activists who focus on long-term value creation sometimes do offer better strategies. In those cases, BlackRock governance team will support the activist plans, and he talks about in that particular year supporting activists in about 40% of proxy contests. Okay, so nevertheless, I want to be able to take this to the data. I just want to point out, and this came up a little bit in conversations that came up in some of the papers yesterday, to make this claim, you have to also implicitly, or at least you should be explicit about the fact you're also assuming the markets are inefficient. Right? And nobody typically who espouses a short-term, the short-termistic view says, I think these are short-term sort of strategies and markets don't get it, and that's why they seem to work. And in fact, this phenomena, that may be true, but this phenomenon has existed for 20 years, right? So you'd really have to argue for a sort of very strong form of market inefficiency or high and strong limits on arbitrage for people to consistently make these mistakes and not learn. Okay, but I just wanted to point this out. And so where does our work fit? I don't want to survey all this literature, but I do want to say that we had some papers like Shai's that looked at what happened when a firm goes public on its propensity to innovate, the quality innovation. Luigi has a nice paper that looks at what do you get, presumably, if you get an exogenous shock to ownership, institutional ownership. What does CEOs do? They get incentivized to do more or less innovation. I'm going to come back to this paper because we know one thing about activism, that CEO turnover is, doubles. So if you buy Luigi's story, he would say, well, there's a much more higher turnover. There'll be less of a sort of susceptibility, willingness to innovate. So I'll have to reconcile or try to point how our work is consistent with his. But last point, when you look at this work, I think sort of Amit Seru's, I think that was his thesis as well, he essentially looked at what happens to innovation in a conglomerate, and essentially when you expand the boundaries of the firm. And he found that sort of when you expand, innovation kind of declines. We're going to go the other way around, because it's not always true, but I would say typically it's the case that activists will seek divestitures, will seek sort of to shrink the boundaries of the firm, seek more focus. So in many ways, I'm going to look at sort of at the boundaries of the firm kind of declining, and I'm going to try to argue, to convince you that innovation seems to go the other way relative to what he documented. All right, so, when you start this project, you start starting to think, okay, what does ICANN know? How is it that patenting activity or the impact on your patent portfolio might be affected by having an activist on the board or just having the presence of talking with an activist? And I think there's two ways. One which is more you can think of it as a byproduct, right? So it's not necessarily that I am telling you what to do with that molecule or how to go about changing the way you deal with the patent office, but rather I am forcing you to change your payout policy, forcing you to change your capital structure, leverage, forcing, changing the compensation scheme of your technology officers, the CEO. All of these ultimately might filter into better incentives to those who actually innovate. And so in that sense, it's more of a byproduct. But you have instances, you have cases, and I've listed some of them here, where innovation is center stage, right? So we had a very famous, sort of well-known proxy fight back in May in 2015, I believe, when Peltz was trying to go on the board of DuPont. And I would argue the innovation there was certain stage. You can kind of see these quotes where really the company was trying to say, we want to stay together as a conglomerate. There really are a lot of synergies by having the people from ag talk from the people from material sciences and specialty chemicals and so on. And Ed Garden kind of, is basically saying, we don't see that. Where do we see the large fraction of revenues is driven by these products that presumably benefit from innovation? And it was already sort of understood that they wanted to break that conglomerate as essentially is happening since Coleman was replaced. So you have DuPont, but you have other cases where an activist comes on board. For example, I'll give you one more example. Starboard and AOL. Starboard filed the 13D with AOL, didn't really say too much beyond just communicating with the board. But then in the First Amendment, they pointed to the hundreds of patents on the books and trying to figure out, well, how much are these patents worth? And really nobody had a clue when you see sort of people raising figures, 200 million, 500 million. And at the end of the day, there was an auction in which these about 800 patents were ultimately auctioned and sold to Microsoft. Some of them were leased as well. So it's both a byproduct, but also focus on innovation, and we're going to look at that entire phenomena. Quickly about the data. So the data here goes only through '07 because we're really constrained with patenting information, which we have through 2010. By now, this data, we've been sharing it. It goes through extending to 2016. Anybody here who wants it, we've been sharing it. We have it through 2015. I'm going to skip sort of the how we build it up, but essentially think of it as excluding bankruptcy reorganization, M&A risk arbitrage, and closed-end funds. So try to keep everything that remains where we see activists filing. So the bars give you the overall sample. You see sort of increasing trend in activism, some evidence of pro-cyclicality. I think it declined in 08, 09, and then I think it's probably reaching sort of an all-time high these years. We want to talk about innovation, so I'm going to try to only look at treated firms that innovate in the first place. So how do you do it? You can condition on treated firms that at least have 1 year of positive R&D in the 3 years prior to the intervention, that have at least 1 or 5 patents prior to the innovation. And so here we condition on having at least 1 patent, 1 positive year of R&D in the years prior to the arrival. Again, those definitions don't change as much, don't matter as much. And sort of the count is essentially given by that pink line. And we end up with 553 firms, which are sort of from now on are going to be my treated firms. Okay? Now, it sort of came up, in the discussion when Rob presented his paper. Question is like, who do you match them to? Okay, and there's no, when matching on observables, there's almost as much as you can do. And so here I'm going to show you matching when you go same year, same industry, as close market cap, and then you want to match on change in sort of performance leading up to the treatment. So you can see I'm matching on market to book, year T-3, T-1. You can do it with changes in Q. We have several permutations. You can do propensity score matching with replacement, without replacement, all of these covariant balance, all of that stuff checked in the appendix. But I'm going to run with this for the rest of the conversation. Of course, Bernie would say, and he's absolutely right, that we're still sort of matching on observables and sort of a good first step. And so one of the things that I want to end up with today is give you several counterfactuals, that sort of other sort of ways of varying, looking at the sample, it's sort of subsamples and sort of other sort of variations that would ultimately hopefully convince you that at least some of the changes that we see here would have not taken place had it not been for the intervention. Okay, so that's my goal. There's an interesting point about matching. When you look at the treated versus control here, there's no differences in attrition here. In fact, what is interesting about this sample versus the unconditional sample, one of the things about unconditional sample was that if you look at ex post attrition, there's a higher frequency of going private or being sold for treated relative to controls. Okay, this is not true in the sample. Okay, in this sample, you don't see a lot of sort of reallocation to different management. Essentially, it's the same frequency as these control firms. Okay, so, and another thing that is interesting, I don't want to forget, it comes back to what Jill said yesterday. Typical investment horizon for a typical firm here is about 20 months for the entire sample. For these firms, it's longer. So a little bit sort of going the way you were, your point yesterday. All right, so quickly about the innovation data. So the typical data that others have used before us is the NBR patent activity. You got when the patent was applied for, also grant year, citations, lifetime citations. Think of the technology class as sort of as the industry in which the patent belongs to. And then 2 more data sets that will be useful. This is the Google patent data where I can look at transactions. I can see sort of how patents are reallocated from buyers to sellers. And look what happens to the extent that you buy, that citations are a good measure of a patent quality. What happens to how patent citations once the patent gets reallocated with the sample. Again, this is the data that Shai used in his thesis. where you can actually say something about inventor productivity. Again, sort of another way to think about how efficiency changes treated versus control. So this is the diff and diff setup. Nothing sort of exceptional here. I'm mainly going to look at a setup where I have a 5-year post-event dummy. We're going to look at sort of beta 3 here effectively to see if there's anything, if your diff relative to your fixed effect is different relative to the controls. Firm fixed effect, year fixed effect, and we're going to be very stingy with controls. I don't want to put sort of R&D or things that might be endogenous on the right-hand side, so we're going to keep age and size. Even size, we thought whether to include or not, but those are the only 2 variables that we include as controls on the right-hand side. So I want to set things up, first of all, and again, looking at R&D, more as of an input measure, and then look at some measures of output. We're going to first just begin with what happens to new patents. Again, the stuff that happens with current existing patents comes next. So what happens with new patenting activity? Let's look at what happens inputs. And then as outputs, I'm going to look at the number of new patents and tell you something about the quality of these new patents that you're generating. Okay, that's my first step. Okay, so if you look at dollar R&D, dollar R&D goes down. Okay, treated versus control. The thing to understand because the scope or the size of these firms shrinks, you can't just look at dollar R&D. If a firm splits in half, each of them is going to have half as much as R&D. And so when you look at the R&D, say, per book assets, we also do it, when you scale relative to sales, there's just nothing there. So the R&D kind of scales down with the sort of the size of the firm. But when you look at the output measures, whether it's new patents or citations to these new patents, we actually see an improvement. And in fact, these citations to these patents, it's not that not only the entire distribution shifts. In fact, the best patents of the treated kind of move more relative to the best patents of the controls. Let me just point one more sort of metric here, which I'm actually going to use on my last slide today. So Kogan has a paper where he looks at price reactions to patent grants. And so what you can do is put those price reactions on the left-hand side and see if sort of patents that were created by treated firms have any higher or lower value than controls. And so when you look at the dollar value of these patents created by treated versus control, again, very weak, but still sort of going in the sense of higher value for these new patents. Now, again, we talked a little bit earlier also about pre-trends or no pre-trends and number of new patents, citations, no pre-trends in R&D, many other variables that I don't have here. But what we wanted to see, and again, this is where the conversation on the graphs was useful, I didn't want to see a spike in year 0, not even in year 1, because then you'd really have to be worried about, I'm coming in and kind of basically forcing you perhaps to patent earlier something that perhaps you don't even want to patent in the first place. It takes a while. It takes, the significant coefficients only kick in year 2. So whatever you're doing takes a while to ultimately show up either with new patenting activities. And so far, this analysis of new patents is sort of standard in many ways. Josh Lerner has done it with private equity. And what we wanted to do in many ways is kind of dig deeper, kind of ask, okay, you do more new patents, so what? Can we say something about where do you patent, something more about the nature of the patenting activity? And so what we do, we use these 3, let me just tell you what these proxies are. So we look and ask, okay, let's look at the treated firms and ask its patents, its recent patents that it just came out with over the last 3 years, to which technology classes do they belong to? Okay, and then construct something like an HHI measure. So are you really concentrated? Are you really innovating in one technology class? Or are you kind of a DuPont? All right? And then we basically ask that effect that I showed you in the previous slide, where is it coming from? Is it coming from the DuPonts of the world or the firms that at the outset are already focused? And essentially all of that effect comes from the DuPonts of the world. Right? So you're going after firms, at least that effect on new patenting activities comes from firms that are sort of more diverse. Okay? Now the question is, what exactly do these firms do with these new patenting activities? You can think of DuPont just creating more new patents in some marginal technology class just because the activist forces them to do it. And so what you can do is we go out and say, for every treated firm, what is your key technology class? Where did you tend to innovate the most? And we ask, do we see more of these new patenting activities in your key technology class, yes or no? Again, all relative to the control firms. And what you find, all that new activity comes from your key technology class. Okay, so you focus on what you're doing presumably best. Still, you might say, well, even to the extent, I do hedge fund activism, the fact that I do a 10th paper on hedge fund activism, what's the return on that? Not particularly high. And so what we do then is say, you've created a new patent. Okay, I can see what that patent cites. Okay, are you really citing all your old stuff on activism, or are you doing something new, but within your key technology class? And so a patent is, classified as explorative, and again, you can play around with this cutoff. Is most of the citations are to, patents that not its old stuff effectively. And patents are deemed exploitative if you're kind of citing your old stuff. And so when you again go in the same framework in a different diff setup and say, what's the fraction of explorative patents that treated do versus control, that's where you get the kick. So the story that we're getting out of it, you're focusing on what you do best, but you're doing something new. Okay? You're not just more of the same. How am I doing time? 10. Okay, so let me quickly spend 4 minutes on this and then jump to the causality. So we talked about patent transactions, and I want to say something about the nature of that reallocation. Again, in our other paper, in our RFS paper, where we looked at census data, one thing that we observe is that peripheral patents get sold. Again, I'm pushing you to focus to be more efficient, sell peripheral assets. And so we want to basically see if that's what's going on here. So first of all, let me say in words what we do here. So you can try to classify whether two technology classes are close or not based on to the extent to which when a patent cites one, they also cite the other one, right? So, and that's how I'm going to ask or deem whether two technology classes are close or not. And so we're going to follow and use that measure. And what is interesting when you look at the propensity to sell patents, which is where we see all the action, first of all, and this is a good sanity check, more distant patents get sold either way, okay, irrespective of whether there's activism or not. What is interesting is that when you look at before versus after, before, treated firms tend to do less selling, but you see a flip of the sign after the arrival of activists, and more so when the patent is distant. So the activist comes along, treated firm kind of tends to start selling distant patents, and again, you can see sort of this nice flip in sign. Now, we want to describe what happens to these patents once they get reallocated. Perhaps we can shed some light on whether this sort of reallocation, this market is efficient or not, or the degree that it is. Of course, we don't have prices here, so we have to do with this data. So these are citations to patents that get sold after the arrival of the activist. And so you can see that once you get kind of owned by different management, they get a bounce back in the citations that they subsequently received. They share the same trend in declining citations for patents sold by the control firms, but we don't see a rebound for the controls. Now, the question is again, whether this is sort of a good counterfactual. I want to give you a few more again. So not only do we try to benchmark the pattern of citations of the sold patents by the treated firms to those sold by the controls, the other counterfactual that you may want to contemplate is, had I not sold that patent, the evolution of citations could have been like the best patents that the treated firm chose not to sell. Right? If you're really concerned about activists pushing firms to sell their best assets, then one hurdle might be, well, had you not sold, you would have earned the same citation as the good stuff that you tend to retain. And so we can look at the best patents that both target and control firm, best patents that they retain, and even relative to that hurdle, okay, that reallocation seems to do well, you're receiving sort of these high citations. And one thing that I don't have time to go through, sort of as a sanity check, if you literally go and look at the attributes of the patents that get sold, what you find is that stuff that gets sold relative to the best stuff that gets retained is, again, more peripheral, based on that distance measure, older, and just doesn't get as many citations, again, which is consistent, again, with you hold on to these assets, let somebody else manage them, commercialize them, more so than you. So I don't have a lot of time. I'm going to skip the invented stuff, but I do want to essentially venture into my last section, and I'm going to go as far as Ishai is going to let me. Okay. So I'm going to talk about some potential channels. There's no way that I'm going to tell you that it's one channel versus the other, but just to give you some confidence that some portion of this is sort of might be due to the activists. So first of all, let's talk about CEOs and incentives that CEOs might face. So what you see here is the percent of firms with at least one CEO turnover within the 3 years prior to the treatment. And so you look treated versus controls, there's no difference, okay, which is kind of good, right? So I want to basically show that even on attributes that I didn't condition on, treated and controls don't look that different, and they don't. But you can see, and this is what I alluded to early on, when you look at turnover post-treatment, it's gigantic relative to controls. Much higher CEO turnover for the treated firms. This is where Luigi's sort of paper comes along, because if CEO turnover is higher, then how does his story work with sort of our way of thinking about it? Because CEO might not have the same tenure because they tend to be replaced. So I want to tell you something about both job security and essentially measure the tenure of the CEOs. Okay, so I want to split it into two. I want to look at, again, pre-treatment, tenure of the newly appointed CEOs prior to the intervention is essentially the same. Okay, no difference, treated control prior to the treatment. The tenure of to the extent that you have been replaced after the treatment, it's actually longer than the controls. I mean, I would have settled for no difference, but it actually, Marisa Mayer is brought on by Third Point. She actually stays, you can see here, sort of marginally significant, more so than a replacement in one of these control firms that I described before. So you get longer tenure if you've been brought on, and if you remain, then where is it? It's right here. If you remain, again, this is slightly larger but insignificant. So it's either slightly higher or no different, but we don't see whether you are retained or not. We don't see sort of that CEO's tenure kind of shrinks post-arrival of the activists. In fact, if you look at CEO ownership, no difference pre-treatment. And you can see sort of a higher rise in CEO ownership relative to CEOs at control firms. In fact, even the ownership, this is all from 4.4, if you look at the ownership of CTOs, same before, and it's not large, but certainly goes up post-survival. There's more skin in the game. So certainly on incentives, we see things kind of going sort of one way to perhaps, that are consistent with these changes. Another channel is the board. We talked about it a little bit yesterday. So the two things, so we kind of go through these bios, again, treated versus controls, and we try to kind of look at the attributes from these bios and based on keywords and try to classify them into your expertise. And sort of as Rob was sort of talking in his paper about the nature of the board members that the dissident brings on board, you can see here that when you look at sort of keywords related to innovation and financial expertise, again, not big, but sort of going the right direction, slightly higher than those brought onto the board by on these control firms that have not been targeted. Okay, and you can see the same thing when we kind of rank it in a different way. So it's these two channels, but let me talk a little bit about causality and then I'll stop 2 minutes. Okay. So as I said, the challenge here is that I don't want to, I don't think that it's meaningful to talk about randomly assigning a firm to an activist, right? So one way to, or at least one way that we think about how to think about sort of the causal effect of an activist is to say, you have been paired with a firm. Can I somehow find a way to exogenously change the effort that you're putting into the monitoring or whatever you're doing? And so I'm going to try to give you some tests along this line. Again, as Bernie was saying early on, propensity score matching is a good place to start. Certainly, we have selection on unobservables, so it only goes so far. I'm going to show you a few of the tests that we've done. But I do want to say, ultimately, again, if we think about this phenomena, if in fact all of these changes, all the other changes that the literature has documented, would have taken place just with passive ownership, why bear all of these costs? Why be undiversified? Why bear, the P&G costs, millions of dollars? Why do it? Year after year, presumably, if you're looking back and you're saying, damn, I should just passively file a 13G and just, spend, several years just owning it passively. Right, so these are very sophisticated investors. The fact that they choose to bear these costs probably is consistent with at least some of their effort is needed beyond just passive ownership. So let me talk about three things that we do. First of all, we look at one kind of factor, we look at one subset of engagements where we can see that there's hostility. Okay, so there's either a shareholder proposal, there's a threat of a proxy, maybe even threatening to sue the company. In instances where we see hostility, to the extent that I'm going to find the same changes, it's more likely than not that it's due to the activists, right? You kind of said, I don't want to do it. We see an improvement. Again, should shift your priors a little bit towards the effort alternative, and you can see, again, slightly weaker results because we have sort of a quarter of the sample, but same message from this subset. The other way to do it is to basically look at an exercise that we've done in the past in our previous paper, which is looking at 13 G to D switches, okay? And so here you're looking at instances where I'm looking at a benchmark where you own passively. I'm looking at all 13G ownership by these hedge funds. And I'm looking at the subset in which I see a switch to a Schedule 13D, right? So if you think about it, a 13D picks up both potential intervention and the fact that Carl Icahn is a great stock picker versus just stock picking, right? And of course, like in many other IVs, the kind of variation that I get is kind of very local, very small. There's 79 events. But when you do that, same message, of course, less power. But again, you can still marginally reject the no. And finally, let me describe this and then I'll stop. 60 seconds? We're friends, right? You can give me, I can borrow from future.
We borrow from Andrew.
All right, so here's what we do with this exercise. So think of this date as the 13D date, okay? And so what I'm going to do, I'm going to go and look for patents that have been filed, say 2 to 3 years prior to the arrival of the activist. Okay, and I really want to grab patents that are filed roughly at the same time. Okay, and now I'm going to look to see when they're granted. Okay, now granting, whether you granted 6 months, one is granted 6 months before the other, that should be more random and has to do with the patent office. And so I'm going to look at price reactions to the granting of these patents and compare a narrow window before the market knew that Icahn is there versus price reactions when the market knows that Icahn is there. Right? And so you can see I'm putting these monthly fixed effects on these lags because I really want to compare patents that were applied for in the same environment, right? When the firm was roughly the same, but they were granted either within 6 months before compared to 6 months afterward or in 3-month bins. And when you do that, you find a 30 basis points difference in the value of a patent post relative to pre. And the idea, way to think about it is that when you have an activist on board, the saleability of that patent is probably leads to higher value. And so we think that at least that variation on whether you're slightly granted before or after is really exogenous to sort of the sort of the exercise or the outcome variables that we have in mind here. So I'm out of time. I'm not going to read the conclusions, but that's the story.
Oh, excellent. Thanks very much. The discussant is Andrew alone, so Eugene is kindly offering you a loan.
So, good morning. Thanks to Benny and to Yishai for inviting me to discuss this paper. And it's always nice to be back and be part of this conference. Let me go into, since I have very limited time, on the paper itself. And I want to set first the big picture. So we are talking about innovation. Why is this important? It's important because, as we know, going back for many years back, if you think about innovation, is the source of firms' competitive advantage and also the source of economic growth. And many of the papers that I'm going to refer to and the papers that I'm going to distance this paper from look at those determinants. And there has been a blooming of this literature over the last 5-7 years. I want to bring in this quote from Williamson from 1985 because I think it's very close to what Alon is trying to do, that R&D innovation is important because in the presence of asset specificity, which is the case of R&D, uncertainty, opportunistic behavior, for example, in these novel projects where there is a lot of opaqueness, where information has to be judged and there's a lot of subjectivity, researchers may manipulate the information that they give to their bosses, especially in the case of resource reallocation. Then differences in internal organization and the ability of outside evaluators are going to be important to impact innovative behavior. Now, to my mind, this paper, I'm going to be more specific later on, it's more about how rather than who is going to affect those determinants. How rather than just the extent of hedge fund activism impacts corporate innovation. And there are two major results. And using a little bit the usual language that we use in this kind of event, but giving it a spin, Alon did a magnificent job about the first result, less of a magnificent job on the second result, and I'm going to focus on the second result. They have a lot. I want to show, I think that Alon is very much interested in showing that the results are as causal as you can possibly get. That is true. I am not going to say much about this, and I will motivate my decision in a minute. So the two results, the two core results, first, firms targeted by activists improve not innovation, but innovation efficiency. That is, there is a tightening of R&D expenditure, but there is an increase in innovation output. That's an important result. I'm not going to discuss a lot about that. What I'm going to focus on is the second result, because the second result will tell me something about the how rather than the extent. And Alon, I think, did not have a lot of time to present this. When you read the paper, you see that most of the evidence there is essentially the meat, right? Is in the second part, that is, how is this going to translate in differences in output? And you can see that there is an improvement mostly driven by firms with a diverse patenting portfolio. There is a reallocation of innovative resources, something that I really like because I'm working on labor and finance. There is a redeployment of human capital. I find this extremely fascinating. They are sketching the surface, but extremely fascinating. But this is the first time that I saw something like this. And there's a change to board level expertise. Now, I'm going to give you the idea of the next 7 minutes. First of all, I want to say congrats to Alon and his co-authors. Their paper is forthcoming in the JFE, which means that this, they are talking about reshaping innovation. This outcome redefines my role, because if I were to discuss the paper itself, it will be useless to the authors and unfair to you. right? Because this, we can discuss at the margin about causality, propensity score matching, so on and so forth, but I think they have done a lot. They have a lot of quantity and a lot of quality. The paper is 85 pages long, and they have a lot of quality in there. So my comments are going to be three. The first one, that I'm going to focus on redefining a little bit the contribution of this paper to the literature. So I'm going to put the second core result in a bigger canvas. Second and third, these are my views about future work or suggestions that we can think about, given that this paper, as it is going to be published. Okay, so the first one is the role of hedge fund activists vis-a-vis other types of institutional investors, and I will be speaking about assortative matching given the stage at which the firm is finding itself. Alon couldn't make a lot of presentation on this. And the third comment is going to be about how should I think in terms of hedge funds being able to change, to carry out these changes. In a sense, are these innovation-specific skills, or are they part of a more general skills that the hedge funds have? Okay. All right. So let me first give you the first comment. So I went through the innovation literature, and it has bloomed like these flowers in front of us. It really bloomed, and there are competition, bankruptcy laws, labor laws, corporate venture capital, investors' attitude towards failure. You start also becoming breathless, stock liquidity, firm boundaries, analyst coverage, institutional ownership, dependence on external finance, etc., 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 etc. You can go on and on and on. So the first question that I had to deal with is the following. Is this paper just about another determinant of what drives innovation, right? Because seen from that perspective, say, okay, we know that somehow analyst coverage matters, somehow institutional ownership matters, is hedge fund, and my view is, no, that is a wrong way of looking at this paper. And that is why I think the second core results are much more interesting, because for the first time, we don't have just a 30,000 feet type of discussion or results, that is how analysts affect innovation, without telling me how this is going to translate. We're going to go from A to Z. We'd never know. This paper makes a nice contribution because rather than who, it is telling me something about the how. And that is why I think this evidence from the ground is extremely important. And I think the main takeaway that I would like everyone to remember this paper for one, as a discussion, I would like to make the statement is this second result. The first one is very important, true, but this is where I think they are making a very important contribution, because they are telling me how these things happen. So this is the first thing that I want to say. And perhaps this is complementary, because Alon, given the time constraint, may have focused more on the first result rather than the second result. And I want you to understand that effectively it's a very broad, not a narrow focus. So the next two comments are going to be more about, for future work, or to redefine a little bit the underlying economics of this. So, as always, the question is this really a question about these results are being driven by an activist hedge fund, so specific to it, or there's something coming from an institutional investor, any institutional investor who has ability to monitor management, ability to address career concerns, which are very important, size to match up the threat, so on and so forth. So is it specific to hedge fund or not? And the paper that you need to benchmark against this is the Agion, Van Rienen, and Zingales, 2013, that Alon mentioned. And what they find in this paper is that, contrary to the view that institutional ownership induces a short-term focus in managers, these institutional investors, in the case of Agion et al., a broad net of these, their presence boosts innovation. And importantly, they speak to the risk considerations of the managerial level. So these results are complementary to, or Alon results and Quarter's results are complementary to Aguirre et al. What would be interesting is to effectively think in terms of how does this paper deal or relate to this big picture, this big canvas of institutional investors. And it would be interesting, so first of all, I want you to understand that because of the second core results, the mechanisms, this paper by Alon is different than the paper by Aguirre et al. Because they are showing us in this paper how this is happening. And that is important for me. But from an underlying economics perspective, it's very important to make the distinction, is this just an institutional investor thing or a broader, or a more specific hedge fund? Because this is going to tell us something about the market-based corporate governance mechanism. Now, one suggestion that I was thinking about, and is just an idea that I have no literature to back it up. It is possible that there is a sort of assortative matching that is happening here. And assortative matching not just between the institutional investor or the hedge fund and the firm, but the institutional investor, the firm, and the stage at which the firm is finding itself. Let me give you an example. Think about a firm that needs to first boost and increase its patenting portfolio because it does not know where this is going to go. You need to really beef up the patenting portfolio. It is possible that by virtue of long-term institutional investors, for example, shielding the manager from short-termism, a generic long-term institutional investor may be useful in that kind of a firm, in that point of its life. It's also possible at one point when the firm is going to leave that stage and closer to commercialization, where you need something which is focused, which is more aggressive, a long-term institutional investor may not be the best outcome, may not be value increasing. And in that case, if you are after commercialization, you want to have a hedge fund, an activist hedge fund that will push you through those mechanisms that Alon and Cotters find to a more focused, rootless approach. And I was thinking in terms of this assortative matching, in terms of finding the underlying economics of the hedge funds versus a generic institutional investor. That is the second comment. The third comment is, are these skills that we are finding, are these outcomes that we are finding, that is, they are going to force certain changes in the board, helping inventors to stay, so on and so forth. That is essentially, if you want to be specific about it, you really are saying that they have innovation-specific skills, because you are going to be able to really understand this R&D is going to do very well, this R&D is not going to do very well. So the first question that came to mind is, are these results due to innovation-specific skills of the hedge fund, or a more generic level of skills that leads to, for example, slashing of capital expenditure, which is different than R&D. And secondly, that these results bring up is, how does the individual hedge fund get those skills? How is it learning? Is it a type / culture / approach? Or is it due to a manager effect, right? And then answering these questions, I think, will take the literature further, because you are going to provide an important color to the nuanced picture that you have. So all in all, as I said, it's very well executed and convincing. It's a very long and high quality paper. Addresses a lot of these concerns about causality, about matching, so on and so forth. It's they do as much as they can. There's nothing to fault at this stage about it. You can discuss at the margin. Where I think this leads to, it's an invitation for further research, and I would like to think more about the role of hedge fund activists vis-a-vis other institutional investors, and then opening the black box of the hedge fund itself. how does it get those skills? I enjoyed reading the paper very much. Thanks a lot.
Thank you very much. Very interesting paper and very interesting discussion, even though it's Andrew. So comments, questions? You done?
Yes.
Maybe a microphone because it's being recorded.
Hi. So it's not really specific to the paper. I would like to see some sort of connection between what you see here towards optimal contracts for how do they affect essentially contracts to managers?
Okay. Chart one by one for Reshape. What's the
Let's collect a few. Is that okay? Sorry, I want to go ahead.
So if I understand the Agnoda paper, they argue that increased institutional ownership alleviates career concerns by managers and therefore they invest more. Now we know that increased institutional ownership also makes mutual activist intervention more likely because there's the coalition. They should have more career concerns when the average hedge fund activist comes to the door. So I didn't quite understand how you reconcile these two views in the world revenue.
So my thought was, and this is partly data-driven, partly how to interpret it. So since you have data for the firms after the engagement, right, I'm guessing that this conditions the sample on those engagements where the objective of the activist is not putting the company into play for a takeover, where afterwards they go private. Because otherwise you wouldn't really observe them in public markets afterwards. So I was wondering whether there's potentially an argument about, so here it looks like there are real effects, and it's interesting what activists are doing on, let's say, on boosting the efficiency and the productivity of innovation. Could it be that, let's say, the other part of activism that is potentially more opportunistic, not doing anything, just putting the company into play, actually doesn't do this? So could there be a nice contrast in approaches and in potential outcomes and how much the activist actually can do inside the firm, or they're just selling it to the highest bidder?
All right. So first of all, if attrition rates are the same, treated and controlled, so we carry all firms until the list, and as I said, listing rates are the same. Now, of course, what happens when these firms go private, you will here are the patterns you do observe, right? Because even if the firm goes private, I can trace what happens to the citations. So in that sense, it's not subject to your concern, okay? I think more generally, you might be worried about firms disappearing from the sample. This is sort of the initial concern that we had sort of with the earlier studies. That's why the census data was very useful, because there you can trace the plans even after the firm has gone private, and then we actually find, again, once you go private, TFP actually improves. So I don't think that's Marco, in terms of, first of all, just to set up the Luigi paper properly, the exogenous shock there is making it into the S&P 500. So I defer to you if you think that's an exogenous shock. Okay, but so look, I mean, I think one of their key predictions was on tenure, and again, condition on not being replaced, you remain as long, and so we don't see any traces of sort of, at least on career concerns that would make us worried. But I think more generally, this ties up to the question there. Part of what I think constrains work in this area is that unlike like private equity, for example, except for you two guys, where we get great data, we're sort of limited in kind of being able to go inside the fund and understanding the organization, how do they organize themselves, lockups, how do you deal with the limited partners, and get information from within the firm, their dealings, we don't know. And I think in many ways that's sort of what's kind of been a boundary and kind of helping us better understand, are they good, are they bad? So we try to by using these insider kind of filings, but that's not as good as you'd want it to be. But tell me how to do it.
I just have predictions on how things should. I mean, I would be really interested to see how empirically it's gonna look like. But
It's
predictions on, I mean, it goes really hand in hand with predictions on how to motivate innovation, right? If you look on Gustavo
That's right.
paper and all
That's
that
right.
sort of literature, it goes exactly hand in hand with that. But I mean, I would really like to see, of course you say you can, but I would really like to see how this sort of plays out in empirical stuff.
No, I agree. Part of the thing that's challenging, just as an example, Rob was telling us that spreads go in a particular way post-intervention. Well, if liquidity goes one way, how does it affect the optimal design of the compensation, right? Whether they allow it to be more easily, rebalance or not. So I don't know, I don't know how to think about it, but again, part of it is also data. Let's see if there's anything else. So Andrew, I think, thank you, great. Thank you for the great presentation. I'm sorry, Bernie.
So
Was that?
I did because if there's
Well,
Yes, well, both were very good.
Bernie.
One
a couple
last
of
comment.
methods, thoughts, and then some analogies. So the methods thought is, and at this point maybe for the next project, another way to deal with differential attrition might be to create matched pairs and then drop both out of the sample when either one of them disappears. And so let me just suggest that as an idea for future research. It's not perfect, but it goes part of the way toward dealing with this messy problem of attrition for unobserved reasons.
Right, we try to play with it, either keeping them, replacing them. It's not, I don't think this doesn't change as much, but I agree with you, there's no one perfect way of doing it.
And a couple of analogies. One which was suggested
Maybe
here.
we should, okay.
Later.
I have one more comment, but that's going to be offline afterwards. So,